Two of America's biggest legacy manufacturers, long considered the frontline victims of trade policy, are now calling tariffs a net positive. That's a plot twist that nobody had priced in. GM explained that earlier in the year, it expected tariff costs as high as $5 billion. But by last week, that number had been cut to $3.5 to $4.5 billion, and that even that was being offset through pricing and footprint shifts. They expect to recapture about 35% of the costs. Net impact, $2 to $3 billion. Still big, but far from devastating. GM CFO even said that they expect next year to be stronger than this year. Ford's story was similar, but even cleaner. They cut their expected tariff cost in half from $2 billion to $1 billion. They took a $700 million tariff hit in the quarter and still printed $2.6 billion in EBIT. Warranty costs dropped by $450 million year over year, and quality scores improved. And get this, AI-driven plant upgrades are cutting defects in real time. That's not an industry in trouble. That's an industry that's adapting. Both companies announced they're adding jobs, adding shifts, and building more vehicles in the United States. GM is doubling Equinox output in Kansas, adding a $1 billion energy program in New York. And Ford is adding 1,000 jobs across Dearborn and Kentucky to boost truck production. That's exactly what industrial policy is supposed to look like, even if it's wearing a tariff mask.